I'm Ratke with Walton Street Capital. Walton Street is an established private equity real estate firm located in Chicago with approximately $15 billion of assets under management. We have both a debt platform and an equity platform where we're actively investing in real properties in the United States as well as originating loans. I oversee our debt platform and sit on our investment committee and management committees. So the competitive landscape for real estate debt has definitely changed quite a bit over the last year. I think you really have two competing forces. Number one, some of the traditional lenders that have been in the market, so banks, for instance, are far less active today than they had been in the past. A couple of the reasons for that are they just have large loan books that have not received the same type of recycling and repayments that they had expected when they made those loans. A lot of that may be centered around the office sector. And then secondly, just bank regulatory environment pressures are keeping banks from participating in many of the loans that they had historically participated in. From a debt fund perspective, I guess number two, debt funds are just a little less active today because some of them are more focused on their own internal loan books. So a lot of legacy loans that were made perhaps in some of the more troubled sectors today, they're a little less active because a lot of their attention has turned inward. However, the competing force to all of this is, transaction volumes are a lot lower than they were, call it back in 2021. So there's fewer opportunities out there. There's still several, lenders showing up to those fewer opportunities, especially the high quality ones. But the landscape has certainly changed. And then the final point from a competitive dynamic, so many debt funds had been very reliant on warehouse financing or repo financing or even cutting a mortgage on a loan. And lower bank participation in that space has created issues for a number of debt funds to lever their loans and has made the competitive landscape a little less tight than it was, say, a year ago. I think if you look at the landscape of debt funds in the market, there are a few key areas where each differentiates from each other. First off, what is the model? Is it an origination model where you're actually originating loans with a borrower, structuring those loans, working with senior lenders to generate your return? Or are you a model that just relies on banks and other insurance companies to source opportunities and then you buy from the street, so to speak? So that's the first, I think, differentiator, a whole loan originator versus just a buyer of secondary interest in loans. The second really would be the asset and market selection. So what sectors in real estate are they focused on? What particular markets are they focused on? I think those are some key themes that you want to dig into when you look at any prospective debt manager. The third would be, what is their leverage? What type of leverage do they use? And I think this is where the rubber meets the road, so to speak, on many fronts. When you look at the underlying risk with some debt funds or lack of risk, right? So is it a senior mortgage mezzanine loan model where you're bifurcating the risk? Is it a repo model? And if so, is it match term? Is it mark to market? Is there underlying recourse to that senior financing? Is there any fund level borrowings? How much cross collateralization does the book have? So I think these are all differentiating factors when you look across the spectrum of debt funds. And then finally, the last element, I think, which is really important, is how well equipped is that debt manager to take over an asset if need be. Now, debt funds are not generally in the business, of making loans and anticipating to take control of the real estate. But I think, many debt funds have both the debt and equity platform where they have that depth of expertise to be able to oversee an asset if they need to take it back. And then there's other pure play debt funds who maybe are a little less well equipped to do that. So I think those are the key elements when you look at a debt fund in terms of how they differentiate. So for most debt funds, their loans are based on SOFR. And SOFR generally has seen an increase almost on a one-to-one basis as the Federal Reserve has raised the federal funds guidance rate over the last year. So think about a year ago, we were operating in an environment where rates were near zero on the SOFR side, and now they're approaching 5%. That's brought about a whole number of themes that are really in the market today. Number one, as the cost of debt has risen on the floating rate side, debt service coverage levels have gone down. That's a big factor when you consider that a lot of properties that were bought in the prior years were bought at very tight cap rates. Certainly, those properties have seen some cash flow appreciation, but it's very unlikely the case that that cash flow appreciation has covered the rapid increase in the cost of debt. So that's the first thing in terms of coverages. They most certainly have gone down over the last year. As a result of those coverages going down, and as a result of really equity buyers looking to buy many of these assets on a levered return basis, you've seen some valuation declines. You've seen some cap rate expansion in these assets to account for that rising cost of debt. Another theme you've seen is the cost of hedging, which has gone up dramatically. So for the longest time, as I think about our own loan portfolio, we have SOFR caps on all of our loans, and those are generally, in the last few years, have been in the 2.5% to 3% range. Those were mere administrative burdens to effectively renew every year or two, depending on the underlying term that our borrowers have bought those caps. They were very minimal costs. Well, today they're effectively prepaid interest. So under the terms of many of our loan documents, we have 2.5% to 3% SOFR caps. And with SOFR approaching 5% today, renewing that SOFR cap is very, very expensive. And so the cost of hedging has really been a huge theme as I look over the past 6 to 9 months, and was expected to continue to be over the coming year. So investing in debt today is very attractive because it offers capital preservation, downside protection, and current return. When you look at the macro equity markets, for instance, and you see a lot of pricing volatility in terms of where assets are trading or not trading or expected to trade over the coming year, debt offers you an opportunity to be, call it at 65% of current value today. You have real cushion junior to you in terms of the equity. You're not really betting on any or really much of capital appreciation on the back end to generate your return, because you're making your return all along the way on a current basis. So we tend to think it's a very attractive sector to invest in today for all those reasons. When you think about how would you go about diligencing a debt platform, and how would you go about diligencing and figuring out which debt platform may be right for you, I would focus on what are the assets and markets they're covered on. What is their leverage profile, in terms of how they're borrowing, if they're borrowing, where they're borrowing, what are the terms. I would dig into that heavily. And then finally, I would invest with a manager that you believe is well equipped to deal with issues, should issues arise, really in the coming years from a lending portfolio. So our team's very excited about current market conditions. The loan structures that we're seeing today are incredibly lender friendly. So we're seeing a lot of interest reserves. We're seeing a lot of extension tests that are pretty well defined in terms of the underlying business plan. We're seeing lower loan to values. We're seeing a lot of equity come into these transactions. So from a lender perspective, we really like the lender friendly structure. The other key theme that we're seeing, which I think is as important, is for the longest time, these floating rate loans have offered a great hedge in a rising rate inflationary environment, and they're proving to do that today. The other benefit we're able to get in today's market is we're able to get a floor on the underlying loan, so the underlying SOFR level of the loan. And as a result, we're kind of in a perfect storm where, if and when, as we see rates continues to rise here over the coming year, as the federal fund rate continues to go up, we also have downside protection to the extent that we saw later this year or maybe in 2024 a cut in rates. We have an embedded floor in that underlying credit. And keep in mind, debt funds generally as well also have a cap at the underlying credit level as well that the borrower is responsible for not only buying but maintaining throughout the duration of the loan. So It's a very, I think, very interesting market to be a lender in today. It's a little less competitive than it was a year ago. And from a structural perspective, it really feels like we're able to get all the bells and whistles that we'd ever dream of, especially compared to lending over the last 5 to 10 years. So in summary, we think it's an incredible time to be an investor in the debt fund space. We've seen rates rise dramatically over the last year, and debt fund managers have seen their returns go up almost lockstep with those increases in rates. We see a market today that's very friendly from a lender perspective in terms of the structure we're able to get. And we overall think we're well hedged for continued rate increases, but also downside protected with floors that we have on our loans today to the extent we saw a cutting spree go on from the Fed here later this year or into next year. Now, if this is a sector that you think you could be interested in and you want to spend time diligencing a manager, the most important thing is to understand where the embedded risk is in their strategy. Is it the assets? Is it the markets? Is it the cash flow profile of the underlying loan? Is it their leverage strategy? Is it different types of borrowings they're doing? It's really important that when you walk away from a diligence session with a manager that you really understand where that underlying risk is and make sure you're comfortable with that risk. We tend to think, there's many great options out there. It's just important for you to match your underlying risk profile with the return you could expect with any given debt manager.